Gold has touched $2,000 just this morning. It has dropped off since. I have Adrian Day with me of Adrian Day Asset Management. I don't think I could have found a more qualified investor, newsletter writer, commentator in the sector to discuss whether we've just seen a difficult week or a significant change in the markets. I'm really curious to hear his thoughts on sort of the fallout of last week. We've seen UBS buy Credit Suisse for pennies on the dollar. Signature Bank closed down. Silicon Valley Bank has been closed down as well. Is it just a difficult week? Is it just a blip on the radar, or is there more to it? And Adrian, it's great to have you back on the program. It is good to see you. Thanks for joining us.
Well, thank you very much for asking me. Couple of thoughts. Couple of the way I'm looking at this is I honestly think what we saw last week could be a fundamental shift for the bullish side for gold. I put out a bulletin at the weekend saying the horse has bolted the stable. And I say that for two reasons. One reason is the banking problems that we saw, Silicon Valley, Signature Bank, Credit Suisse, the problems that we saw show us that you can't raise rates in the US from zero lower bound to 4.5% in less than a year and expect nothing to break. Everyone's been talking about something's going to break. Well, something broke. And I think it would be preposterous to think that the only financial institutions that are teetering on the edge were the ones that went bankrupt, the ones that went under last week. So that's the first thing. There's more to break from the rate hikes we have already seen in Europe as well as in the US. The second reason I say it's the cat's out of the bag or the horse has bolted the stable, or whichever one you want to use, is the Fed's response, the central bank's response. Both the Swiss National Bank and the Fed threw money at the problem. And basically in 10 minutes, the Federal Reserve undid half of all the QT, quantitative tightening, that they did in the last 12 months. And again, I think we can reasonably assume that they will do the same with the next problem. So both of those factors make me say that this is a fundamental positive shift for gold. Having said that, if I may, and we were talking before the program, in the immediate term, I think there's cause for caution. You know, when you see gold move from 1,800 to 2,000 in the space of 10 days, you know, that doesn't continue. Markets don't move in straight lines. So we've already had a strong move in response to what's happened. I think the risk now is for a pullback. Either the markets start to feel calmed, maybe the Federal Reserve, as you know, is meeting tomorrow with the announcement in the press conference on Wednesday. I think they will raise rates, but if they raise rates quarter of a point and then Powell comes out swinging in his most hawkish that he can possibly muster, saying inflation fighting is still our number one problem, we've taken care of the banks, don't worry about that, and the markets believe him, then gold will come off again. So there's a lot of reasons to think that gold is vulnerable at this point, and some of the factors you mentioned, that the juniors aren't really moving, that silver, particularly today, has come off. You know, in a good market, you expect the juniors to be moving fast, and you expect silver to be moving faster than gold. So anyway, those are my fundamental thoughts.
Yeah, no, really, really interesting. We're pretty much celebrating, by the way, the first anniversary of the first Fed rate hike. I think it was
Yes,
March
indeed.
16th. So I was like, I'm not wearing a party hat or anything because I don't really feel like celebrating here. But
Well, I'll celebrate with some water.
but yeah, interesting points. We have the Fed meeting this week, and like through all the financial crisis noise, or Bloomberg, a commentator on Bloomberg called it a financial situation, not a crisis, because it didn't want to go there. We have a financial situation in the markets, a global financial situation. I love that term. That's why I'm stealing it. And then the Fed on Wednesday is coming out with their statement. I think the language will be really important there, and what they're saying, because we've tried already to be smarter than the Fed, and we've tried fighting the Fed starting in November, and then we've been beaten to a pulp here as a junior mining investor just earlier this year as well. Do you see that scenario repeating itself? Because I don't share the enthusiasm of some of my colleagues in the sector that are very bullish on the junior companies right now.
Well, it's interesting because for the last year, people have obviously asked me, as they've asked you, hey, with inflation and a war, why isn't gold moving more? And when will gold move? And without rehashing all of that, my basic point was gold will move when the market believes or realizes, depending on how you look at it, when the market believes that the Fed will not be able to control inflation without causing a serious recession. And I think we're at that point. So I agree with, there are good reasons why we didn't see stronger moves in the last year. But I think we're coming to the point where the market is saying the Fed can't win. And, the Fed is in an incredibly difficult position. There's no doubt about that. Now, it's a position they put themselves in, and we can talk about that if you want. So I don't have a lot of sympathy. I mean, I think the history books, depending on who writes them, the history books will judge Bernanke and Yellen and Powell very, very badly. But where we are right now, just looking at where we are right now, they are in an impossible situation. And just looking at this week, if they don't raise rates, then the market will question their inflation fighting credentials. If they do raise rates, we're only causing more damage in the system, in the financial system and economy.
Maybe to touch on that, like I mentioned before we hit record here as well, like the Silicon Valley Bank crisis or default sort of set off this financial situation here in the markets. I'm having a hard time saying this is a systemic issue. Okay, I think it was the trigger for something, and you're probably right. There's other banks that are also teetering on the edge here, but it seemed like utter stupidity caused the crash of Silicon Valley Bank. No risk management whatsoever. And as I said earlier, we've had 1 year of Fed rate hikes already. So there's a bit of a, you'd expect there was a learning curve involved when you buy bonds. You higher interest, or you have higher interest rates. Your bonds usually drop, or the value of bonds, and there needs to be a hedge, right? That's how that usually works. And the banks haven't done that, especially Silicon Valley Bank. I'm sure others have failed in that department as well. So if the Fed comes out on Wednesday and Jerome Powell says, like, okay, we're actually raising 25 basis points, we're going to keep continuing because the inflation topic hasn't been defeated. Is he just saying, well, you've been utter idiots, we're going to keep going, this is just a blip on the radar screen? Like, would that actually calm markets? Or would he say, like, well, do your homework, guys? Like, we're here for the bigger picture.
Yeah, it's an interesting question because I'm not really sure what will calm markets. I think his press conference this week is going to be incredibly difficult because he's got to thread the needle multiple times. He's got to let the market know that there is not and will not be a banking crisis, and they will do whatever it takes to stop the banking crisis. At the same time, he's got to convince the markets that the fight against inflation continues. So it's a very difficult position. I agree with you completely on there was no systemic risk at Silicon Valley or Signature. I agree with you completely. They were isolated incidents, and Credit Suisse, better than I, has been a slow-moving train wreck for years now. So it's just suddenly you've got a sentiment in the market, and that caused other things to break, but they weren't related in a systemic way, in the way that Bear Stearns had a systemic risk because of loans out and so on. But having said that, two things. One is sentiment is very important. And if three banks in the US go down in 1 week, there was also Silvergate, probably Silvergate's forgotten about now, but there were three banks in the US plus Credit Suisse, that makes people nervous about banks. And everybody starts looking around for what could be the next one. In the US, it's First Republic, whose stock is down again this morning. I don't know enough about First Republic, to be honest, to have a sensible view on it. But the point is, the sentiment in the market latches on to things that are considered risky. Deutsche Bank, perhaps. Again, you would know a lot more about Deutsche Bank.
Yeah, that'll be a painful collapse, I'll tell you that. So.
Being in Germany, but you know, so people look at things. So that's the first thing. Sentiment matters. The second thing is, yes, each of those was a separate situation. I agree with you completely on Silicon Valley, and we could talk about the signature, because they had the same sort of. Well, they had Barney Frank as a director, Barney Frank of Dodd-Frank. So these politicians like to tell us how to do things properly, but they're not very good at doing it themselves. Anyway, but do we really believe that those are the only banks out there that are teetering on the edge? Of course not. And so I agree completely that there's no systemic risk in the proper meaning of the word. That doesn't mean other banks or other financial institutions, insurance companies, pension funds are not having problems from 12 years of excessively easy money suddenly switching to aggressive hiking. Of course, people should hedge, but do we really believe everybody has hedged properly? No, of course not.
We've seen that this week, or last week, right? In the last 10 days, that they haven't. Adrian, let's circle back to gold and what's affecting the gold price right now. It's obviously more than just the banking crisis or the global financial situation. And what else do you see weighing on gold right now? Let's put this behind us a little bit and discuss what other factors you're looking at or you're considering right now that could impact the gold price, positive and negative.
Yeah, I think the two big factors, well, the dollar is obviously a very critical factor for gold, price in dollar for US investors. We know that the currency, whatever currency you choose to measure gold in, is the most important determinant for the price of gold, obviously. And gold was up in most currencies last year because most currencies were down against the dollar. But from the US point of view, the US gold price, the US dollar is the most important. One of the things that gives me a little bit of optimism on that, frankly, is that, you know, last week, and I honestly haven't looked this morning, I'm sorry, but last week, the dollar was down, and the dollar is normally a safe haven. But the dollar was down, the Swiss franc was down until Credit Suisse came in, and the yen, I'm sorry. And the yen was also up all week, even into the Credit Suisse. And so is the global safe haven switching from the dollar to the Swiss franc and the yen and gold? Could be, and that would be very, very positive. You know, another factor, obviously, is the stock market. You know, all investors have a choice of what assets to put their money into. And gold typically does better when the traditional assets, stocks and bonds, are not doing well. Obviously, bonds aren't doing well now, but as the stock market is up today in the US and in Europe, it was up last time I looked. But if the stock market starts to, I think the stock market is very, very vulnerable. But if the stock market falls meaningfully, that will see a shift of some assets into gold. So I think that's a positive indicator.
It's interesting. I was just, when you mentioned the stock market, I'm just looking at Europe on average is up almost 2%, being it France, Germany, Italy, the major indices, right? The US is up 1.1% right now, just while we were recording this. So obviously investors feel confident in the system again and feel a certain level of confidence, obviously, that all is going to be well at the end. Do you agree? Like, and where's that confidence coming from? Like,
I think the other thing is you've got some significant short covering. So in certain sectors, so if you were short banks, you might want to cover some of those shorts. If you were short commercial real estate, you know, and the market starts to move, you might be covering some of those shorts. So in certain sectors, there seems to be some short covering in the US this morning. That's what I'm hearing from different institutional investors. But I think definitely the market has sighed a sigh of relief. To me, I can't speak for Europe sentiment, but in the US, there is a huge amount of complacency, in my view. If you look at the bull-bear ratios, we have various indicators of the sentiment among retail investors. There's the investor indicator, there's the bull-bear ratio, there's the American Association of Individual Investors, and so on. The latest I saw was last Wednesday. So Credit Suisse was already in the headlines, and certainly the Silicon Valley and so on had already happened. And yet the bulls on the stock market, even at the depth of the crisis there, were 2-1 against the bears. To me, that is astonishing. You would expect retail investors to be much more bearish than that. And the other thing, frankly, Kai, let me just pull up the latest numbers, because if you look at the S&P 500, which is the broad index in the US, and you look at consensus estimates for next year's earnings, let me just pull this up. Last year, the S&P earned $222.45 per share. The consensus estimate is for $220.71. So the analyst consensus estimate is for S&P earnings to decline by less than 1%, 1% over the next 12 months. Now, to me, that's just astonishing. It could happen. They could be right. But to me, there's an awful lot of risk in that kind of forecast.
Well, I'm just listening to the news this morning as well. Amazon just announced another round of layoffs that makes it 27,000 for the year, right? They changed strategies, like, oh, we don't need another 9,000 people, so they're going to get laid off. And the tech sector doesn't look very healthy. Obviously, they overhired during the COVID times, and Amazon is probably a prime example, because everybody ordered from home, and the stay-at-home model was flourishing. That's changing. But where else do you see weakness in the in the markets? Like, I've just had Ronnie Stöffler on this morning as well, and he said, well, we were looking at a recession. There's no doubt, like, we're going to slide into a recession in the coming months.
Yeah, I agree with that completely, for a lot of reasons we can talk about. But yeah, I mean, the complacency in the market is unbelievable. Now, let's not also forget one big factor. Markets move on flows. There's an awful lot of cash still out there in the system. In the US, the bottom half may be beginning to struggle with credit card balances built up and now credit card defaults. But the top, 5 or 10%, there's still a lot of cash around. And that cash has to go somewhere, right? It can go to Bitcoin, it can go to real estate, it can go to gold, but it has to go somewhere. It can go to the bank. You can go and put it in the bank if you want. But the cash has to go somewhere. And in this kind of environment, I think where you look at most money managers today have never seen a real bear market. If you've been managing money, or if you've been an institutional investor for 20 years, let's say, from 25 to 45, or even from 30 years, you've seen your lesson. The lesson you learned is buy the dips, right? For the last 30 years, buy the dips worked. And I'm not talking about big dips. I'm talking about short-term dips. It worked. And so I think that's what we're seeing. People are putting money to work in the stock market. I suspect, we will see, if I suspect this bear market will be provoked by earnings, by lower earnings, unexpectedly lower earnings. And you mentioned some. We're already seeing it this year. I mean, looking at what companies have already announced this year, I honestly don't know how analysts can expect a less than 1% earnings drop for the next 12 months. But that's the fact. So yeah.
Now, it's going to be an interesting Easter break for sure, because that's when usually the Q1 numbers come out. So, and
That's right.
I think Easter is the first week of April, if I'm not mistaken, Adrian.
Yeah. Now, some companies will be helped because inflation's come down a little bit, so their costs will be a little bit better. We'll see a bit of that. But the economy in the US is certainly rolling into a recession. There's no question about that in my mind at all. The hikes that we've already seen, right? Again, from 0 to 4.5%. The effect of those hikes is not already in the economy. It's only beginning to be seen in the economy, right? Remember, Milton Friedman told us that monetary policy works with long and variable lags. And the lags can be a year, 18 months, depending on the sector that we're talking about.
No, it's interesting. Like I was talking also with Ronnie, actually, that's why it's top of mind. But I used to say, and I've said that in other interviews times and times again, we need to scare the 401k money to move, right? And they're all in the major indices in the main markets. They haven't really looked, and you brought up the juniors as well, GDXJ, GDX, even the ETFs, they haven't really recovered yet, and to any level that's somewhat sustainable, in my opinion. Um, Again, you said the earnings might be the trigger. You think that'll be enough to scare the 401k money? Are they, for lack of a better term, educated enough to understand what is going on?
Well, that's a really interesting question because 401k money in the US is a huge part of the market.
Exactly.
And a huge part of the market. And the way it works with most 401s, some 401ks are individually managed. We have some people's 401s that we manage. But the vast majority of 401ks is in the company plan. And the way it works typically is every year, the company will say, okay, here's the 5 mutual funds that you can invest in. What do you want for the year ahead? And I have people all the time, I have clients all the time who come to me and say, hey, I have this 401k with my company, you're not managing it, but do you mind helping me out on this? And they send me the choices that they have. And the choices are US big cap, US small cap, global, if they're lucky, global big cap, bonds, short-term bonds and long-term bonds. Those are the choices. With most people, they don't have the choice of buying gold stocks. They don't have that choice. And so when they get scared, they're going to have to go to the cash fund. There is a cash option with most of these. But most people, if you've got a 401k, you really don't want to put it in cash. That's not what it's for. It's meant to be a longer term investment. So that money, which is very, very sticky, of course, as people get laid off and they take the 401s with them, then they can convert them to IRAs. They can do what they want with it. But and that will be one trend. But most of that money is very, very sticky, and most of that money is restrained in what it can invest in. But I do think we'll see. I mean, if you see earnings down meaningfully and the stock market starts falling, I'm sure a lot of people will just switch to cash, temporarily.
Well, cash is trash in that case, in my opinion, especially if you're sitting at a 6% inflation rate, right? So that's not really helping you either.
Of course.
So, Adrian, let's circle back a bit. I want to talk more about what you're doing at Adrian Day Asset Management. Just to gauge the sector a little bit, like, are you seeing inflows these days? Like, obviously, you have a very heavy like precious metals and resource focus at Adrian Day Asset Management. Are you seeing inflows? Is the interest picking up?
Yeah. Well, I can also talk to the gold fund that I manage as well, if you don't mind. So
Yeah,
just
for sure.
generally,
Yeah.
I would say we saw a meaningful and steady inflows once the Fed started raising rates and inflation got onto people's radar. We started seeing, steady, I would say, steady inflows for most of the year. But at the end of the year, December, it just fell apart. December, January, and most of February, you got nothing. And we were getting withdrawals, in fact. Last 3 weeks, it turned around again dramatically. And we've started getting inflows. We're starting getting more requests for new accounts. The fund is getting inflows. So the sentiment has definitely changed. Now, of course, as we know, unfortunately, sentiment always follows price, and however much everybody says they know the time to buy is when things are cheap, the truth is sentiment always follows price. So, we'll see if this lasts, but we're definitely getting inflows now. Yeah.
Yeah, interesting. Okay, that's interesting to hear because again, I told you I have a discussion with a good friend of mine. Who's like, he's rather bullish, while I would say bearish. I think that's the wrong term, but as you said, cautious is probably the right word. Like, I don't buy it just yet, right?
Okay.
And I should be the optimist running a PR firm in the gold space, right? I just want to
Yeah.
get burned because I'm an investor as well, and I put some money at work in November, December as well, and quite literally, I have been burnt. Right? So I'm underwater. I haven't sold anything. Like, I'm too loyal to the sector to sell, right? But Adrian, like, talking about asset allocation to a degree as well. Like, have you changed your allocation focus a little bit? And what I'm trying to get at is, like, have you moved in more into juniors, or are you still with the
Yeah.
bigger names?
Good question. For the last, couple of years, I've been focused primarily on the larger companies because the larger companies are always not only the first to move in a gold bull market, but they're also the more certain to move. In other words, I could buy, and I'm just naming them at random, Agnico, Newmont, Barrick, Kinross, Goldfields. And if gold goes to 2,500, you can be pretty sure that those stocks will move, right? You could buy Consolidated Moose Pasture and Amalgamated Ajax or whatever. They may or may not move. And so I've been focused on the seniors for that reason, the first to move and the more certain to move. I would say our focus, certainly compared with historically, is still more on the seniors, because the seniors remain, despite the jump we've had, they remain very undervalued on a historical basis. Barrick, for example, is selling very, very close to a 20-year low in terms of price to cash flow. The XAU is in the lower half of most valuation metrics, which is really quite surprising when you look at the gold price. So our main focus is still on the seniors, but but more selectively, I must say. But also in the last couple of months, we have really started buying more in the juniors. When I look at the exploration stocks today, yes, I agree with you, but most of them haven't moved. It's very frustrating. But when I look at the ones I'm looking at, I don't see a lot of downside in most of the names anymore. I think the downside, I won't say it's gone, of course not. But there's very little downside in these stocks unless something dramatic happens, I think. You've had 2 years where the junior gold stocks have had significant losses. So, I don't think there's a lot more tax loss selling or anything else to happen. And with a lot of these companies, more and more, the stocks have gone into stronger hands. So even though most of them haven't started to move yet, I think the setup is a lot better today than it was, say, 6 or 9 months ago. And we are buying, but we're buying extremely selectively among the juniors and focusing, number one, apart from management, I always focus on management as my number one, but balance sheets. Balance sheets are critical. Because if we have a weak stock market, which I'm expecting, we have a recession, which I'm expecting, maybe a little bit more financial situations, it will be more difficult for companies to raise money. So you want a company that has money and not just going to have to raise it in 3 to 6 months.
No, interesting. And one of my points of the presentation at PDSC was, if they have to raise, they need to raise big, or they should go home, pretty much. Like, go big or go home. Like, it's easy to raise 30 million. I've been talking to institutional head of sales while I was in Toronto. They said there's a lot of money on the sidelines. They're willing to write big checks, but they're not writing small checks. Right? It's really interesting.
Yeah. And your point also was another critical one. You talked about companies that raise small amounts of money, and 3/4 of it goes on, I'm paraphrasing what you said, I'm sorry, and 3/4 of it goes in G&A. Well, what is the point of giving a company money if they're not going to do any work, right? And sympathy for the company and all of that sort of stuff. But if a company owes its contractors, and there's a debt that's owed to the chairman of the board who bailed him out last year ago, we should not be writing checks to pay the contractors what's past due and to give the chairman back his loan. I mean, it's all legitimate, but it doesn't do us any good.
No, there's no value creation happening, right? I think the number wasn't, I need to look it up again. I think 63% of all financings were below $2 million, right? And 51% or 52% of them were below, or of the total were below $1 million. That's an insane amount of numbers of way too small financings. Like, you're not creating any value.
Of course, of
right?
course.
So,
And
interesting.
of course, you know as well as I do, in this business, everyone running a junior gold mining company is an optimist. They have to be, or they wouldn't be doing it. They're always an optimist. And so I can't tell you the number of times that people have come to me and said, we're going to raise money, but we're only going to raise $1 million now, because after our drill holes come out and the stock goes up, we'll raise more.
One of my favorite sayings. It's easy to hit bingo on that, on the card, when you hear that. Adrian, one last question. Newcrest and Newmont are supposed to merge, or at least Newmont made an offer for Newcrest. It has been rebutted. Twofold question. A, do we need to see more M&A in the sector? And B, is it actually healthy? Do you see the low valuations in our sector being of hindrance right now for more M&A?
Yeah, we definitely need to see more M&A. I think we need to see more M&A among the juniors, frankly. We just talked about some companies where 75% of their money goes to G&A. We need to see more mergers among junior companies so we can get the G&A down. And there's a lot of resistance to that, because, of course, typically, if you're merging 2 or 3 juniors, and one of your focuses is to reduce G&A, that means laying off people. And so it means one of the CEOs isn't going to be CEO anymore. So there's a lot of resistance to that. But I definitely think we need to see more among the juniors. We will see more among the seniors and second tier, because, the major mining companies, you're producing 5, 6, 7 million ounces of gold a year. You cannot find These companies cannot find 5, 6, 7 million ounces a year. And so in order not to shrink, and very few companies will put out as a business plan for the coming year, our 5-year goal is to shrink by 30%. Very few companies will say that. So in order to stay where you are, you either have to acquire those ounces, or, another important factor, you have to switch from gold and go to copper or lithium to boost your production. That's a whole different subject we haven't touched on. But in answer to the question, or the subject, I think we're definitely going to see more M&A. Part of the problem with low prices, of course, is that it makes if you have a low stock price, it makes a bid seem very opportunistic. And the shareholders don't really like that. They don't want to be taken over at a low price. And that was part of the problem with the Newcrest deal, of course. The stock was at a low. They only had an interim CEO. And so Newmont, no blaming them, thought this is a good time to strike. But as you said, they were rebuffed.
No, absolutely. Adrian, really, really enjoyed our conversation. Where can we find more of you?
Gosh, I'm getting up. Adrian Day Asset Management, all one word, adriandayassetmanagement.com.
Fantastic. Awesome. Adrian, we said we were going to keep this at 20, 25 minutes. It's been 34 minutes, but I tremendously enjoyed our back and forth.
And
really
you, thank you
appreciate
so
your
much.
time. Thank you so much for coming on. It was tremendously
No,
insightful.
it was very good. Thank you so much.
Fantastic. Everybody else, thank you so much for tuning in. We hope you enjoyed this episode of Soar Financially. If you have, there's a little square box usually, I think, on the side. I think YouTube actually changed the design, but it says subscribe on it. Doesn't matter if it's a square, rectangle, or an octagon. I don't care. Click on subscribe, because I know 85% of you watching are not subscribed to this channel. I'd highly appreciate if you change that. That way we can get other high quality guests like Adrian Day here on the program and share some financial wisdom here with you and give you some insights that you might not hear on mainstream media. Really appreciate your time. Thanks so much for subscribing. Leave a comment, leave a like, and we'll be back with lots more. Thank you so much.